So good morning. I hope you can all hear me, and somebody will let me know if I'm still on mute. Welcome to our webinar. It's being recorded and you'll receive a copy of the slides afterwards. If you have any questions throughout, if you could please put them in the Q&A. I can't guarantee that we'll have time to answer them this morning, but if you have questions, I certainly will follow up with you later if we're not able to answer them today. My name is Sarah Barron. I'm a senior manager in Menzies VAT team, and one of my specialisms is VAT and property. So the webinar today, VAT, property, TOGCs, it's a massive topic, and I could quite happily spend all morning covering it in detail. I'm not quite sure you'd be so happy about that. So what I've designed is a fairly high level canter through, so we can look at when a transaction can be a TOGC, why we worry about whether it's a TOGC or not, and some of the actions that are required to make sure that that happens. We'll look at the impact if it's wrong, and that will lead us on to some of the protections that can go into our contracts to make sure that things can be unwound and corrected if anything does go wrong. So we're going to go back to some fundamentals, because I always think it's easier to ask the right questions if you understand what the reason behind those questions is. One of my favourite things that I have to review every now and then are the standard property questionnaires. In there's the question, if it's not a TOGC, however unlikely this may be. And hopefully by the end of this webinar, you'll be able to spot when it's unlikely to be a TOGC or simply it cannot be. And the reason we worry about whether it's a TOGC or not is if it's not a TOGC, for VAT professionals, we assume that on every transaction, the start point is that if you pay somebody in return for goods or services, we assume that you're going to charge, that there's going to be a VAT charge on that at 20%. And VAT legislation then goes on to set out all sorts of reliefs and exceptions to that fundamental start point that enables you to charge VAT at different rates or not at all, or to just put things completely beyond the scope of VAT. But unless we fall fair and square within those definitions given within the VAT legislation, we have to assume that there will be VAT at 20% on this transaction. So for property transactions, there's a whole plethora of VAT brackets that a transaction could fall into. We're aware that if we build and sell new homes, that will be a zero rated supply. But for the purposes of this morning, we're going to set aside residential property. We're just focusing on commercial property. So if you sell bare land or a commercial building, that will fall within the exceptions in Schedule 9 of the VAT Act, and that will be exempt from VAT. There are some exceptions in there, but we're not going to focus on those this morning. So a supply of land or commercial property, we'll assume that it's exempt from VAT. But then we fall into a very unusual situation for VAT where you have a choice. In the VAT Act, there's the choice for qualifying transactions of commercial property. You can say, no, I don't want this transaction to be exempt from VAT. I want to charge VAT on it. I want to make it taxable. And the reason you might make that decision is because if your supply, the thing that you sell, is exempt from VAT, you can't claim back the VAT that you incur on the costs. So if we take an example, we've got Fred, he's got some spare land at the back of his yard, and he decides to build a little industrial unit and charge rent on it, and that's his retirement plan. So Fred gets a builder in to do the work for him, and he pays the builder VAT on those services that he supplies. And the only way that Fred has the right to recover the VAT that he incurs on having that property built is if he opts to tax. So he says, I'm not going to have the rent on my property exempt from VAT. I'm going to charge VAT on the rent. So then that gives him the right to go back on his VAT return, claim back the VAT that he's incurred on constructing the unit. He charges VAT on his rent to Sid, the car repairman who uses the property. And because Sid is using it for a business purpose as well, taxable business purpose, he can claim back the VAT that he pays on the rent. So when we've chosen to opt to tax a building, that option to tax is personal to you. It doesn't bind anybody else. The wording in the legislation is that you opt to tax your interest in the property. So if you have a legal interest in that property, you can opt to make it taxable for that purposes. And it's a common misconception that once a building is opted, it's always opted all the way down the supply chain. That's not the case. Each person can choose whether or not they opt to tax that building. So going back to Fred and Sid, if Sid decides to sublet part of the unit, he doesn't have to opt to tax his interest in the unit. He's got a legal interest as the tenant. He doesn't have to choose to opt his interest in the unit. He doesn't have to charge VAT to his on his sublease. There would be some impact on his recovery of the VAT upstream, but he doesn't need to take that decision. So you don't need to opt to tax to use the building if you're using it wholly for your own taxable business purposes. And those taxable business purposes are anything that you're doing on which VAT is charged at standard, reduced or zero rate. So once you make that decision to opt to tax the building, it's a two-stage process opting to tax. You have to take the decision and you have to notify HMRC, and it becomes effective when both of those things are in place, the decision and the notification. So you notify on the HMRC form, the 1614A. There's a whole suite of forms for different notifications to do with options to tax. And you have to give the details of the building that you are intending to make taxable, your interest in it. And if there's the form only asks you to give the postal address. It gives you the option to give the title number and submit a plan as well. But the more information you can give when you are notifying that option to tax, the easier things will be down the line. We know that title numbers can change and postal addresses, it's not unfeasible. I know of a building, we looked at a project where somebody specialised in buying inner city commercial units, office buildings. They bought a unit that was it was a corner plot. And they, when they bought it, let's say it was called the Unicorn Building, and the address was number 1 West Street. They converted that building into student accommodation, and they changed the name of the building. And when they bought it, the front door was here on number 1 West Street. and by the time they've reconfigured everything, they've moved the front door to number 100 South Street. So the building has a different name, it has a different postal address, title numbers can change, but because we've got a plan of that building showing the corner unit, the corner plot where it was easy to identify later on that yes, that is the plot that we've opted. So my advice and one takeaway is, if you've got clients that opt into tax, just give as much information and keep as much of that information to hand, so that years down the line, when you come to revisit this, you know exactly what you have opted to tax. And the second big takeaway, I would say, is to keep copies of what you notify with the property details. 10, 15 years down the line, when you come to have another transaction with the building, if you told your client, you know, you finalise the property transaction, you're sending them the title deeds, tell them to keep a copy of the option to tax and all the documents that are submitted with it. That will save delays on a future sale. Similarly, you don't need to wait for an acknowledgement from HMRC to make that option to tax effective. As soon as you've taken the decision and submitted the notification, that's it. You don't need to wait for an acknowledgement. So coming back to our main topic of TOGCs. So if we go back to our earlier slide, we've decided that the sale of a land or a commercial building is exempt from VAT without an option to tax. But in VAT, we're really hung up on definitions. We love a definition, and we'd like to identify exactly what it is that we're selling. So are we actually selling just a building, or is there something else? Is there an economic activity around that building so that what we're selling is more than just bricks and mortar? And if there is a business tied up with this building, then it's not a building that we're selling anymore, it's the business. And you won't find the word the sale of a business in that Schedule 8. So that's not exempt from VAT. It's not in Schedule 8, it's not in Schedule 9. So it's not hitting any of the reliefs. So we go back to our first principle that if you're selling something that doesn't fall within any of the schedules, you're charging VAT at 20%. So if you're selling a business, an economic activity, then we assume that we have to charge 20% on it. But that's going to cause all sorts of cash flow issues. You're selling a business for £1 million, and the buyer suddenly has to find an extra 200,000. That's potentially deal breaking. And if you've got a nice little business going, we don't want to prevent that. We want to keep that going. It's beneficial to the economy if you've got a decent business to keep it going, to facilitate passing on that business to somebody else who wants to take it forward. There's an extra set of reliefs available in the VAT Act, in the VAT Special Provisions Order, that says when all the criteria are met, we deem that transaction to be not a supply. We're simply passing on an economic activity from one entrepreneur to the next. That's not a supply. And when there's no supply, there's no VAT charged. So to identify this transfer of a going concern, this passing on of an economic activity from one entrepreneur to the next, we need to be happy that the person taking on this business, their VAT status falls fair and square on all fours with the previous owner. So are we using the assets for the same kind of business? And we'll look at that in a little bit more detail next. But it needs to be the same kind of business. Moving away from property transactions, if we are selling an Italian restaurant and it's going to become an Indian restaurant, that's pretty much the same business. But we've got the same sort of clientele, same location. That can still happen that's going to qualify as the same kind of business. We need to make sure that if the seller's VAT registered, we don't want this business dropping off the VAT registration, so the buyer must also be registered. And it must be reasonably capable of continuing in business. And we don't want this thing being just passed along through lots of different hands. So there mustn't be lots of different transactions. It's just one transfer from one person to the next. But then when we come to property businesses, then there are some extra requirements to make sure that all the criteria are met. And that is the VAT status of the building can't change. So if the seller has opted to tax, then the buyer must do so as well. And we need to make sure that that option to tax is effective and isn't hit by any anti-avoidance provisions, so that the option to tax wouldn't actually operate. So the one thing that is most likely to make a TOGC fall down with a property transaction is that it's not the same kind of business. So looking at the examples on the screen, the most likely one, the one that we come across most frequently, is the sale of the property. So we've got Fred's property letting business. If we sell it to the tenant, that's not the same kind of activity. So we've got Fred, his business is property letting. If we sell it to Sid, who's the car repairman, he's not using it for property letting anymore. He's using it for car repairs. Now, the day-to-day activity in that building, that's not changed at all. The people are still in there doing the same work, but we look at Fred's interest in the building. Are we selling it to somebody who's going to continue to let it, or are we simply selling it to somebody who's going to use it for something different? So in the case of Fred and Sid, if you are selling to your tenant, that's not the continuation of that going concern. That's not the same economic activity, and that can't be a VAT-free transaction. Then so if Sid decides to buy the property from Fred, but then in a couple of years he wants to recapitalize his business and decides to sell it and lease it back, again, that one can't be a TOGC because we've got Sid the car repairman selling back to a property letting business. So the sale and lease back, it's very unlikely to qualify as the transfer of a going concern. We can have problems created if you're selling properties, selling business activities within VAT groups. There's a lot of VAT legislation is quite often to do with businesses within exempt insurance groups, selling off back office operations. But we need to look at, if you've got a sale within a VAT group, you need to look at that on a case-by-case basis just to check whether, yes, there's sufficient going across, is there actually a business? And because of the particular nature of VAT groups, we look at those as one entity in the most part. Is there actually a transfer happening at all? And then we have the situation where you've got partially let properties or a partial portfolio or an empty property. Is it possible for a sale of a property like that to be a VAT-free TOGC? If you've got a portfolio of 10 properties and 9 of them are let and one of them's got a board outside to advertise it, then that's clearly there's an economic activity. If you've got a couple of people there managing the buildings, there's an economic activity there, and we're not worried about the fact that 1 or 2 of the buildings aren't currently tenanted. If you've got a building that somebody's acquired and they've actively looked for a tenant, they've found somebody, they've agreed terms, and the tenant has agreed that they'll take a lease from the new owner, that person has done a lot of work. There's been a lot of economic activity preparing that building for letting. So we'd be happy that that can be a VAT-free transfer. But if you've got somebody who's just bought a building with the intention that they might let it out at some point, but they've not actually done anything about it, then no, that can't be. There's no economic activity that we're transferring. It's simply the sale of a building. So the leg of all the criteria that need to be met, if we think back to our, what needs to happen for this to be a VAT-free transfer of a going concern, we know that we need to opt to tax. But the one that gets often forgotten, and it can make the whole thing fall down if it's not done, is it's the 5.2b notification. You'll have seen the reference to 5.2b in the contract, and that is basically a notification that the option to tax that the buyer takes isn't going to be disapplied by anti-avoidance regulations. So if the buyer is going to be letting the property to a connected business, so say we've got an insurance holding company wants to buy a property and they're going to let it to their exempt insurance trading business, their option to tax wouldn't be effective because they're letting to a business that's connected with them, and it's not able, that business isn't able to recover its VAT. It's a nice boost to the cash flow if the holding company was able to claim back the VAT that it incurs on the property up front and then drip it back down into the insurance business as irrecoverable VAT over a number of years rather than having a big hit up front. But the anti-avoidance legislation says no, that's not allowed. You can't take advantage of the rules in that way. Your option to tax is going to be disapplied. So that holding company wouldn't be able to give the 5.2b notification to say their option to tax isn't going to be disapplied. So they wouldn't then fall fair and square, mirroring the VAT status of the business at the in the hands of the seller. So the TOGC criteria aren't met. So if the TOGC criteria aren't met, and we have actually treated the transaction as VAT-free, the seller is going to be liable to VAT. So the seller has to pay the VAT over to HMRC. Are they able to recover that from the buyer, and is the buyer able to find the funds to pay it? And from their perspective, is the buyer going to be able to recover any VAT? There's timing issues if we've assumed that there's going to be no VAT on the transaction. Does the buyer have to put things in place before the relevant date to make sure they're able to recover? There's also going to be an impact on the SDLT because that would need to be the SDLT would need to be charged on the VAT as well. And similarly, if we treat a transaction as a supply, so we charge that. This most often comes to light when a buyer tries to recover that from HMRC. if they've submitted a large repayment return because they've got a big chunk of VAT to recover, Revenue will look at that carefully before they make the repayment. And if they think the transaction should have been a TOGC, they'll refuse the repayment. They'll say, no, you've got to go back to the seller, get it back from them. Are we able to unwind that VAT charge and update the SDLT? So to make sure that we've hit all the criteria, we need to make sure that the transferee, the recipient, is registered or registrable at the relevant date. Now, the relevant date is the earliest of payment or completion of a transaction. If there's a deposit, that can create a tax point if it's paid as cleared funds to the seller. But yeah, so the transferee needs to be VAT registered or registrable, which means that if the turnover of the business is over the VAT registration threshold, they become registrable at the point when they receive the business. If the turnover is below the threshold, we need to make sure that we've got a VAT number in place, because technically they're not registrable. It's a voluntary registration. And for overseas buyers, so if you've got an overseas landlord buying a UK property, it's wise. It might not be essential, but we need to review it on a case-by-case basis. But it's wise to make sure that the VAT number for an overseas buyer is issued before the relevant date. Also, yes, obviously the option to tax needs to be notified to HMRC before the relevant date. If we've got all the information to hand, an option to tax can go in. It can go in in a couple of hours, so long as we've got all the information and we can get it signed. But that needs to go in before the transaction completes. So when do we start thinking about that in a transaction? My favourite phone call is the one that I get at 11 o'clock on a Friday morning. Sarah, we're hoping to exchange on this transaction this afternoon. What do we need to do about the VAT? And I think, well, what you needed to do was talk to me about a month ago. So there's things that you can have in place. So at the start, when you start thinking about selling a property or a portfolio, gather all the information right from the outset. Have you got copies of your notification, of your acknowledgement of an option to tax? So to give you a chance to do that, retain the copies when you make the option to tax. Keep those with your property information. HMRC have recently changed their policy. They're no longer issuing those nice acknowledgements that set out all the details of the property. They're just giving a receipt. We suspect that there'll be a lot of to and fro with people wanting to see an acknowledgement, and you don't get that anymore. You just get a delivery receipt. There could be delays if it's unlikely in the TOGC situation, but some people will need permission to opt to tax a property. So if we've got all the criteria met, we're happy it's a TOGC, but if I'm asked to review a contract just to make sure that we're happy that we've covered all the clauses, all the right protections in there, I'm not teaching any of you to suck eggs, and I don't draft legal documents, but if I'm asked to review something, I would just check. It states that the intentions of both parties are clearly stated, and it gives gives the right, if anything goes wrong, it gives both parties the right to unwind the position. So give and receive a VAT invoice, receive payment if it should have been, there should have been VAT chargeable. And we can think about the timing. If that does need to be charged, is it possible to issue a VAT invoice to the buyer so that they can recover quickly from HMRC before they have to pay it over, and then the seller needs to pay to HMRC. How do all those timings fit together? Can we make it as painless as possible for everybody? And also, you know, just if it's not a TOGC because of the actions of one of the parties, who's responsible for any penalties, any interest that might be charged? So a quick recap, is it a VAT-free TOGC? The most likely cause is that it's not actually the same type of business. So there's not a property letting business being transferred. The registrations, it's a housekeeping matter. We should be able to meet that in time. Similarly for the option to tax notification, the 52B notification, can the buyer actually give that? Are they entitled to say that their option to tax will not be disapplied? And do the contracts contain all the correct declarations and the right to correct the position if anything has gone wrong? So it's just after 10 o'clock. Hopefully that has given you a little bit more of a background. I appreciate it's a really quick canter through with me talking at 100 miles an hour. But if you would be interested in a face-to-face follow-up, then you know, I'm more than happy to come out and give you a little bit more detail, talk about some scenarios you've faced. And if that would be of interest, please let us know. Otherwise, thank you very much for your time. And if you've got any questions, I think we're already over time, so I think we will do follow-ups to the questions that I can see in the Q&A. But otherwise, thank you for your time, and I hope you have a very good day.